Good afternoon, George and Martha. Thank you for coming in today. I do appreciate your time. I do appreciate the time we spent over the last few months getting to know each other, and I've had the ability to finally get the report in front of you. And for today, I want to talk about a few things in detail in the report, some things that I think are some big opportunities for you. And at first, we'll discuss the actual goals you're trying to accomplish, and then we'll talk about the recommendations I have to make these goals happen. So to start, I will just say, high level, we're going to talk about retirement as well as estate planning. So for your retirement accounts, first thing I want to talk about is your AirTech 401k, George. You stated the desire to fully distribute the account upon retirement. Normally, for people who don't need liquidity from their 401ks at retirement, I would suggest systematically drawing down the account over a number of years. The advantage here being every dollar you pull out of a 401k or an IRA account increases your taxable income dollar for dollar. And if you can imagine, if you pull all that money out at once, it could create a huge taxable liability for most people. So you have a unique opportunity here. You have access to something we call net unrealized appreciation. You have, for the most part in your account, AirTech stock, which is appreciated a lot. And we expect it to continue to appreciate as well. So going forward, when you reach retirement, you would be able, at full separation from the company, to distribute all the stock in kind to a brokerage account. You would only trigger income taxes at that point on the cost basis in the stock. And going forward, any distributions you take from the brokerage account or any liquidations, I guess I should say, you make in the company stock, all you would pay on that appreciation is capital gains taxes, which is obviously more preferable in your situation to taking advantage of income tax rates. So I will say this is a more advanced tax strategy. You would want to consult your tax advisor to make sure that it makes sense in the year that we do it. Also to make sure you qualify for it. And on a side note, I want to mention the IRS also recognizes a huge opportunity here. This is for anybody that's been able to grow a company, and that the IRS only allows one NUA distribution, net unrealized appreciation distribution, per person in their lifetime. So keep that in mind. This would be something that we wouldn't want to ignore upon retirement. Obviously, we can't do it just yet, but keep on working and we'll be able to get there. On the accumulation side, you mentioned for retirement you wanted to continue to defer more income. So this is easily accomplished. I would say on Martha's end, you need to start maximizing your contributions to your 401k accounts. You have a limitation of $17,500 you can contribute in addition to a $5,500 catch-up provision at your age. So that's the easiest way you could also defer more income. But also, George, you could establish something called a non-qualified retirement plan. Let me explain this a little further here in terms of how it would benefit you. You mentioned to me that you would like to contribute more, not let it impact your current income. You would like to exclude your rank and file employees from this plan, and you'd also like some protection from any outside companies that might be acquiring or merging with AirTech down the road after your retirement. So in a non-qualified plan, we're not subject to the same ERISA requirements that we are in a qualified plan. So we would create this non-qualified plan, and you can be in it, of course Hank can be in it as well. And going further, we would informally fund it using a rabbi trust. A rabbi trust would include provisions that would prevent other outside companies that might acquire the company from using those assets or denying you your benefit in retirement. It would say this money is just for your retirement. The only people that would have access to it other than you would be maybe creditors if something were to happen to the company's viability. So definitely would consider the non-qualified account. I think it's a very great way to save money. There are other strategies we can look at as well. You'll see those in your plan. So moving on, I want to also discuss some concerns I had about estate planning. Some of the easier things we could address here up front, just beneficiaries. You know, anytime you don't list beneficiaries on your account, you really put yourself at risk. You put your assets at risk at going into probate. And establishing beneficiaries can just totally sidestep that. You can have your money go to wherever you want. It supersedes anything in a will. So definitely want to update that. Furthermore, pre-tax accounts like a 401k. George, you got to get your estate off as beneficiary of that account, because what happens when you do that, it just pays out to the estate, and the account is paid out all in 1 year, and it creates a huge tax liability. Please take some time and list Martha on your 401k as the designated beneficiary. We could talk to an estate attorney as well. We might be able to create a trust that could create some opportunities for you as well, but definitely want to get your estate off there and list someone specifically. Furthermore, we need to revisit your wills. They need to reflect your current goals and strategies for retirement. It's been a while since you've revisited your estate, so a lot's changed. Your goals have changed, your financial picture's changed. We need to revisit your will. So I will get you in touch with an estate attorney that can help you cover that as well. We also want to establish power of attorneys on each other. Too often at the time I see a spouse incapacitated and the other spouse unable to make decisions from a legal perspective. Don't let that happen to you. We need to address that. In order to create an account beyond the death of one spouse, we need to establish a bypass trust, which would be established for the well-being of a surviving spouse. Furthermore, it would allow for the full utilization of the estate tax credit when paid out to the grandchildren at the death of the surviving spouse. Could certainly get you in touch with an estate attorney on that as well. Another important opportunity I noticed, we probably want to establish a trust for the out-of-state land that you currently own. We'll talk about how we're going to get that land in Scott's hands in a bit, but for now, what you want to avoid is having that land go through what we call ancillary probate. If you can imagine going through probate more than once, having property in different states would create an event where you'd have to go through probate several different times, going through several different states' rules. We can avoid that easily just by putting that property into a trust. Additionally, to accomplish your gifting goals, getting into talking about estate planning, you'd like to get as much of your money out of your hands as possible and do it in an efficient manner. We could also structure a gifting strategy where each of you have the ability to contribute $14,000 per giftee. So to your kids, you would give $28,000 apiece, right? For your grandkids, we can use this gifting strategy to also fund their college needs. So if you look in the report under the higher education section, you'll see that I took some time and I made some calculations. Using the gift exclusion rules, you could contribute up to the amount you need to fund their college education, what we call 529 accounts, 529 plans. These plans, there's no immediate tax advantage when you put money in, but when they take money out, there's no taxes on the principal or the growth. So we'll definitely look to those to fund your kids, your grandkids' education. Any additional exclusion you're able to fulfill, maybe you have some extra money you can give them, put that in a UTMA account. You said you wanted to delay the time at which they can withdraw that money. A UTMA account for each child would not allow them to have access to the money until they reach the age of majority. So that would be a good way to get your assets out of your hands, give it to your kids and your grandkids in a manner that establishes education funds, but also gives them money as well, just for general needs. So I do want to say I do appreciate your time today. We're going to take some more time here in the future to discuss these goals further, as well as other goals you had. And you should take some time to let this stuff digest. And we're going to schedule some time here soon to talk about next steps, perhaps implementing these things, getting you a referral to the right attorney, the right tax professional, whatever it is to accomplish these goals. And we'd like to discuss a lot of the other things as well. You have some great opportunities here, the investment portfolio, as well as the strategy to get rid of your income-producing parcels of land. So look forward to talking about those goals with you as well. But for now, I do appreciate your time today. George and Martha, you guys take care.